Alright, what we're going to be doing today is a fundamental analysis of General Electric Company. We're going to be doing both a book value and a PE ratio, which is price to earnings ratio. I'll also be doing the same for some other companies to compare. So here we go. This is Q3, October 30, 2018. Alright, so this is the 9 months ending September 30th balance sheet. And first things first, what we're going to do is we're going to find out exactly how many shares. Alright, here we go. Common stock. Alright, so we have 8698115 shares of common stock in which we are common shareholders. So that's 8 billion shares. Alright. And so everything we do is going to be based on that number. So first things first, we want to take a look at the amount of cash. And I want to make note here, the reason why I like to do this is because the Yahoo Finance and all those guys that they put this stuff together, they use their own formulas and calculations for how they go about doing this stuff. There are some standard accounting principles in order to come up with these numbers. I like using my own, right? So what I'm going to do is for cash, I'm going to include this. I'm going to include investment securities. I'm going to include current receivables, and I'm going to include financing receivables. All right. The other GE Capital receivables, I'm not going to include. It's a small number anyway, but I'm not sure what this stuff is, and there's no notes here to tell me what it is. So what I'm going to be adding, like I said, to cash are just these items. So let's do that real quick here. 6,932. And I'm going to make mention all of these numbers are in millions. Okay. So what that means is we're simply going to add 3 zeros to the end of this thing. All right. So that's 26 million. 761, 123. 20414 plus 7918123. All right, so that gives us $90 million. All right, so the question is how much cash do we have per share? All right, and so we're just gonna do 90 divided by, and that's gonna be our 8698115 All right, so we have exactly 1 penny per share cash. All right. All right. Next thing we're going to look at is we're going to look at the inventories. Okay, inventories, property, plant, and equipment, other intangible assets. We're going to take a look at this note here. Contract and deferred assets, another note, and then all other assets. Now you see this all other assets does not have a note here, so I'm very I don't know if I want to include that because we don't know what it is, and it's a fairly large number. We know that property, plant, and equipment, we get that, right? Those are buildings, equipment, so forth. Other intangible assets, like I said, we can look at the note down there, but this all other assets, we have no clue what that is. I'm going to be very careful not to include that because, hell, it might be zero. We don't know what it is. Assets of businesses held for sale, we're going to include that. Assets of discontinued operations, we're going to include that as well. And I'm not going to include Goodwill. Okay, Goodwill is what the business is worth if sold, and at this point we have no clue what GE are selling their businesses for, so we're not going to include that Goodwill. They just recently came out and said that they were writing down their Goodwill like 20 something $million. That's why you see the huge difference here. So we don't know what this Goodwill is. We're not going to include that. Deferred income taxes, looks like that's 10 million. We're not going to add that either because that stuff changes from sometimes day to day and administration to administration. So I'm not going to include that as well. All right, so 86 million, and we'll come back to the intangible assets and these other things here, the contracts, and see what we get. So that's going to be, again, 1 penny. We're going to say hard assets. All right. Now let's take a look at see here, note 8 and note 10. So customer related. All right, so this is going to be a customer list. Okay, I'm not going to include that. Okay, I'm not going to include that. That's where it is right there. Right, we're not going to include that. Patents and technology, we like that. Capitalized software, that's fine. That simply means that it's software that's owned by the company. I'm not going to say that it can be sold, so we're not going to do that. We'll include the patents and technology. We'll include the trademark. GE does have a name, right? The lease valuations is fine, and then you see this all other here, which is a fairly small number, but it is there. I'm not going to include that. So patents and technology and trademarks and their leases. All right. Very small number. We're just going to put this at 0. It's going to be soft assets. All right. Right. This is contract and other deferred assets and progress collections and deferred income. All right. And so what this means is these are projects that are under contract, right? So it means these companies have a contract to continue paying GE for doing some work for them, whether it's building turbines or whatever they may have. And so what we're going to be looking at is what is included in here, and then what isn't. It looks like long-term product service agreements and then equipment contract revenues, deferred inventory costs, non-recurring engineering costs, customer advances, and other contract other deferred assets. Okay, so what we have here is we have the product service agreements. So that's the contract that GE has with the company that says, hey, you're going to continue paying us to come out and service your equipment. That's a very big deal for General Electric. Same thing with the equipment contracts, right? It's equipment that is on, I guess, loan or lease or something like that. So the rest of this stuff, deferred inventory costs, we're not going to include that. Non-recurring engineering costs, we're not going to include that. Customer advances, we are not going to include that. So what we're looking at are these numbers here, and as you can see, for aviation, that number gets pretty big. That's non-recurring engineering cost. Let's look at number E and see what that says here. So it says includes costs incurred prior to production. See this, requisition engineering for equipment production contracts primarily within our aviation segment, which are allocated relatively to each unit produced. So what this means is that these are costs that the company that's paying GE has to pay before they even build the plane or the plane engines and whatnot. We're not going to include that. You know, if this thing gets sold, that is not necessarily going to be sold to another company. So we're not going to include that. All right, so all this stuff is okay. Other, and we'll keep that. Not sure what that is, but we'll keep it. So we're going to use this number right here at the 13. So that gives us, again, 0 cents. So I'm not going to include that. I'll just keep it 0. All right. Okay, so we're looking at liabilities, and so all these are going to be subtracted from the book value of the assets, because these are things that are owed. If the company is sold, these things would have to be paid off. So let's add these up real quick here. Actually, yeah, we're going to add all this stuff. So let's just grab this number here. All right, there we go. So we're going to subtract 2 cents. Liability. All right, that gives us a grand total of 0.00, and the current price is $8.50 roughly. So what this is saying is that if this company is sold, they have $0. They'll get nothing for the entire thing. But because the price is $8.50, that means that that entire $8.50 is currently risk, right? Because there's nothing at all supporting this. All right. Now let's take a look at the earnings, because that is another thing here. Because maybe that price is supported by earnings. So let's find out. All right. So this is the income statement. All right, so this is all the money that's been made and all the money spent to make that money. All right. Now, depending on whether or not they're currently making money, that, like I said, can be part of the price, because technically when you're buying a stock or you're buying a company, you're buying the profit for future years, right? So if I know a company is going to make $10 million next year, well, what is it worth today? Well, it's worth quite a bit, because it's going to make 10 million this year, it's going to make 10 million next year, and so on, right? So let's take a quick look at how this stuff goes. First things first, we're going to take a look at just this number. So GE Capital revenues from services, we're going to go ahead and include all this stuff, right? Interest and other financial charges, investment contracts, goodwill impairment. We're going to take this out, okay? This is more of a tax issue and not necessarily has anything to do with business. Non-operating benefit cost, yeah, we're definitely going to add that. It's going to be your health care, it's going to be your pension liabilities, things of that nature. Other costs and expenses, again, we're going to be conservative in our estimates, so we're going to go and include this even though we don't know what it is, because we don't want to, you know, not include enough. Okay, so this will be fairly simple. All we're going to do is going to take 88,337, right, and we're going to subtract it by 110,604. Okay, but we're going to add back in our 21,973. All right, we're also going to add our other income here. Okay, we don't know what it is, but it is money, and it's very possible that they will continue having that money year after year after year. As you can see, last year the other income was 26. This year is 1275. So we're going to include that. What we have is $981,000 is what was brought in so far for 9 months, ending September 30th. If we divide that by 3, we get roughly 327 a quarter, and we take that times 4. We can expect to have $1.3 million for the year. Okay. All right. So $1.3 million, right? And then we're going to divide that by the number of shares. Okay. And so we got 8,698,115,123. And again, we have a very small number. So that is, yeah, that is no money. Okay. Every share of GE gets that much in earnings. Now we own currently 100 shares, so if you take that times 0.00015, right, that is 2 cents. 2 cents. So the stock price should go up 2 cents every year. And being that there's no well, I'm sorry, the dividend is actually 1 penny. So if we take that and add a penny to it, so that means every year the stock price should go up about 2.5 cents. So again, the price being, you know, $8.50, there's nothing at all supporting that. Okay, there's nothing supporting that at all. This price is literally all risk. This is the price that people are paying for the stock, not what the actual stock is worth. It's what people are paying for it. Now, the value of anything is what people are willing to pay for it, right? If someone is willing to pay $100 for this thing, that's what the value is. But when you look at the actual value of the company, if I were to purchase this company for myself, to own it myself, it is not worth anywhere near $8.50. Okay, and that's what we have to look at. All right, and so because everything in life is relative, including finance and financial decisions, I went ahead and did the same exact thing to GE's most closest competitors. Now, I grabbed the competitors list from Morningstar, which they're pretty good at figuring that kind of stuff out and categorizing companies. The only company I was not able to get really any information on is this Royal Philips, just because it is a foreign company. Siemens was a little difficult to get, but I did get that one, and then I got UTX, United Technologies. So we see GE shares are far above what their competitors' shares are. 8 billion shares, which is exactly why the numbers are so low, right? But the one thing that I want to make mention here is we see UTX, United Technologies. Their total book value is actually negative, all right? The earnings are much better, right? They are showing a profit, but the book value is horrible. That's their closest U.S. competitor. Siemens is over in Germany, and you see their book value is much better. And of course, I think the price kind of reflects that. It's $100 per share. So just there for comparison. Based on the price, GE doesn't look horrible, right? Just because it's such a cheap price. So what that tells us is that GE is much cheaper than these other companies, which makes sense, right? United Technologies is super expensive. But a lot of the reason why is because of the earnings. Okay, so let's just put that here. Book ratio 425, just really good. This book ratio is 887, and this one we got 2010. All right, and then what we'll do is we'll now take a look at the price to earnings, the PE ratio. All right, so as we can see, based on price to earnings, GE is doing what? Horrible. Price to earnings is 56,000, which is more than double its competitors. And the reason why is because the earnings are so small, okay? So again, just to reiterate, all right, so the price to book, okay, which is what is the price versus what the company actually owns, okay, as far as assets in this case are concerned, okay. GE wins the day, okay. Their price is fairly cheap compared to the amount of assets that they own, compared to their competitors. But based on their earnings, what their actual profit is, the price is way too expensive. It's like I said, it's double what their competitors are. And I just want to go back and look at this again. We're looking at our total book value, okay? And again, United Technologies, horrible book value. GE is right in the middle right at zero. Siemens over in Germany, it's doing much better. As far as earnings go, this is profit, right? This is profit every year. Siemens way better, right? And then United Technologies in second, and then GE, it's way down at the bottom. So with all those things being said, if we were purchasing a company based on selling all of their assets, based on this analysis, we go with GE, right? But we are not in the business of buying companies to sell off assets. We're in the business of buying companies to reap dividends from earnings, from that profit. And based on their competitors and their current price, we see that GE is not at all where we want to be. So